For years, most Americans have been focused on the stock market. Every day, headlines talk about the Dow, the S&P 500, and the Nasdaq. When stocks go up, people feel confident. When stocks fall, people worry. But behind the scenes, there is another market that many experts consider even more important than the stock market. It's called the bond market. And right now, according to many economists, investors, and financial analysts, the bond market may be sending one of the most important warnings in decades. The problem is that very few people understand what that warning means or why it could affect almost every aspect of American life. To understand why this matters, we first need to understand what bonds are. When the U.S. government needs money, it issues Treasury bonds. Investors around the world buy these bonds because they are generally considered one of the safest investments available. In return, the government promises to pay interest over time and repay the original amount later. For decades, U.S. Treasury bonds have been the foundation of the global financial system. Governments, banks, pension funds, and major institutions have relied on them as a safe place to store wealth. But recently, something unusual has been happening. Treasury yields have been rising significantly. A yield is essentially the return investors demand for lending money to the government. Normally, when investors are confident, they are willing to accept lower yields. But when risks increase, investors demand higher returns. In simple terms, rising yields can indicate that investors are becoming more cautious. They want greater compensation for the risks they see ahead. While most Americans never think about Treasury yields, these numbers influence mortgage rates, car loans, credit cards, business borrowing costs, and even government spending. What makes the current situation especially important is the size of America's debt. The United States now carries a national debt measured in tens of trillions of dollars. Every year, the government spends more money than it collects in taxes, creating budget deficits that must be financed through additional borrowing. For years, low interest rates help make this borrowing manageable. But when interest rates rise, the cost of servicing the debt rises as well. This means a growing portion of government revenue must go toward paying interest instead of funding programs, infrastructure, defense, or other priorities. Imagine a family that has accumulated a large amount of debt during a period when interest rates were very low. As long as monthly payments remain manageable, the situation appears stable. But if interest rates suddenly increase, those payments can become overwhelming. The same principle applies to governments. America's debt burden becomes far more challenging when borrowing costs increase, and this is one reason why many investors are paying close attention to the bond market today. Another concern is the growing supply of Treasury bonds entering the market. Because the government continues to run large deficits, it must issue enormous amounts of debt. At the same time, demand from some traditional buyers has weakened. Certain foreign governments have reduced the pace of Treasury purchases. Some central banks are diversifying reserves. Meanwhile, private investors are demanding higher yields before committing their money. This creates a simple economic reality. When supply rises faster than demand, prices tend to fall and yields tend to rise. For the average American, this may sound like an issue that only affects Wall Street, but the consequences extend much further. Mortgage rates are heavily influenced by Treasury yields. When Treasury yields rise, mortgage rates often follow. This makes homes less affordable, monthly payments increase, and many potential buyers are forced to delay purchasing a home. Higher rates can also slow housing activity, reduce refinancing opportunities, and create additional pressure on families already dealing with rising living costs. Businesses face similar challenges. Many companies rely on borrowing to expand operations, hire workers, invest in technology, and develop new products. When borrowing becomes more expensive, businesses often become more cautious. Expansion plans may be delayed, hiring may slow, Investments may be reduced. Over time, these decisions can affect economic growth. What begins as a change in the bond market can eventually influence employment opportunities and corporate profits throughout the economy. Perhaps even more concerning is what rising yields may be signaling about investor confidence. Markets do not move randomly. Investors constantly evaluate risks and future expectations. If investors believe inflation could remain elevated, they may demand higher yields. If they believe government borrowing will continue increasing, they may demand higher yields. If they see greater uncertainty in the future, they may demand higher yields. In other words, yields are not simply numbers. They reflect collective judgments about economic conditions and future risks. Inflation remains one of the biggest factors influencing the bond market. During periods of high inflation, the purchasing power of money declines. Investors who lend money today want assurance that inflation will not erode their returns tomorrow. If inflation expectations increase, investors often require higher yields to compensate for that risk. This creates a difficult balancing act for policymakers. They must support economic growth while also keeping inflation under control. Achieving both goals simultaneously is not always easy. Many analysts compare today's environment to previous periods of economic stress. History shows that major financial disruptions are often preceded by warning signs in the bond market, before recessions, before market corrections, and before financial crises. Bond investors frequently noticed problems before the broader public did. This does not mean a crisis is inevitable, but it does mean that bond market signals deserve attention. Ignoring them simply because they seem complicated can be a costly mistake. One reason bond investors are taken so seriously is the sheer size of the market. The global bond market is enormous, involving governments, institutions, pension funds, insurance companies, and sophisticated investors. Decisions made in this market are often based on deep analysis of economic conditions, while stock markets can sometimes be influenced by excitement and speculation. Bond investors tend to focus intensely on risk management. When these investors begin demanding higher returns, many economists pay close attention. There is also an important psychological element at play. For decades, Americans have become accustomed to relatively low interest rates. Cheap borrowing fueled housing growth, business expansion, consumer spending, and rising asset prices. But if higher rates become the new normal, the economic environment could look very different. Consumers may borrow less, businesses may invest less aggressively, governments may face difficult budget decisions, financial markets may experience greater volatility. The Federal Reserve plays a central role in this story. Through monetary policy, the Fed influences interest rates and financial conditions. When inflation rises too quickly, the Fed often raises rates to cool the economy. When growth slows, it may lower rates to stimulate activity. However, even the Federal Reserve does not directly control long-term Treasury yields. Those yields are determined by market participants, evaluating future risks and opportunities. This is why the bond market sometimes sends signals that differ from official economic narratives. Another factor attracting attention is the growing cost of interest payments on government debt. As existing debt matures and is refinanced at higher rates, interest expenses increase. Some projections suggest that interest costs could become one of the largest items in the federal budget. If that happens, policymakers may face difficult choices regarding taxes, spending, and borrowing. These are long-term challenges, but financial markets often begin pricing them in years before they become obvious to the general public. The international dimension is equally important. The U.S. dollar remains the world's dominant reserve currency, and Treasury bonds remain among the most widely held financial assets globally. However, some countries are exploring alternatives, increasing gold reserves or seeking greater diversification. While the dollar's position remains strong, Even small shifts in global demand for treasuries can influence yields and borrowing costs. Investors are closely monitoring these developments because they have implications far beyond the United States. Despite these concerns, it is important to maintain perspective. Rising Treasury yields do not automatically mean a financial collapse is imminent. The American economy remains large, innovative, and resilient. Businesses continue to adapt. Consumers continue to spend. Technological advances continue creating opportunities. Economic challenges do not necessarily lead to disasters. However, ignoring warning signs is rarely wise. Understanding risks allows individuals, businesses, and policymakers to make better decisions. This is where many financial experts believe the bond market's message becomes especially important. The warning is not necessarily that a crisis will occur tomorrow. Rather, the warning is that the era of easy money may be over. Debt levels matter. Interest rates matter. Fiscal discipline matters. Inflation matters. These factors are becoming increasingly difficult to ignore. Investors who once assumed low rates would continue indefinitely are being forced to reconsider those assumptions. For ordinary Americans, the lesson is surprisingly simple. Pay attention to more than stock market headlines. Understand how interest rates affect your finances. Consider how debt influences long-term financial security. Recognize that economic conditions can change. Financial resilience often comes from preparation rather than prediction. Nobody knows exactly what will happen next, but awareness provides an advantage. The bond market may not generate the excitement of a soaring stock or a viral technology company. It rarely dominates social media discussions, yet beneath the surface, it influences nearly every corner of the economy. Homeownership, retirement planning, government spending, business investment, and consumer borrowing are all connected to the signals emerging from this market. Today, those signals are becoming harder to ignore. Investors are demanding higher yields. Government debt continues to grow. Interest costs are rising. Inflation concerns remain present, and financial markets are adjusting to a world that may look very different from the one many people became accustomed to over the past decade. Whether these developments ultimately lead to slower growth, policy changes, market volatility, or simply a new economic reality remains uncertain. But one thing is clear: the bond market is speaking. The question is whether policymakers, investors, and ordinary Americans are listening, because history has shown that when the bond market sends a warning, ignoring it can be far more expensive than understanding it.